All right. Good afternoon for most of you. Good morning to some. Welcome to our monthly call series. Today we're going to talk alternative investments. I'm proud to welcome Chris Mehalko from Infinity Funds onto the call. And Infinity's been one of our earliest partners in the advisor network, a firm I've known for quite some time, a firm that is extremely well versed into a number of different types of offerings in the alternative world. And I really just want to, thank Chris for being a part of this. Thank the Infinity Funds team for partnering and realizing early on that there was a valuable product and service that advisors could be using. So, thank you for doing that. I'm going to kick things off the way we always do, with first of all thanking all of our folks that are coming on the call today, being live for the presentation, but also the folks who watch this on replay. We welcome your questions. If there's a question that you couldn't hop on and you have afterwards, please route the question over to me. You can go directly to Chris, but we're happy to answer questions after today. Just because you didn't ask it today doesn't mean you don't get to ask the question at all. So feel free to ask any questions that are on your mind. How to best ask those questions. We are going to use, again, for today, the process. Please email me your questions. The email address, as always, is Chealy, at theadvisornetwork.org. Chealy at theadvisornetwork.org. I will stop a couple of times over and look for those questions. So, feel free to send it whenever. You don't have to wait till the end and we say it's time for Q&A. You hear Chris say something, you hear me say something, and you want a little more information, send it over. I'll keep kind of checking that as often as possible so that we can make this interactive. On that note, Chris has asked that we do make this interactive. The goal here is to not sit there with the presentation, but we're going to ask each other some questions, and I'm going to have Chris delve into a number of different alternative topics because I think everybody here on the call is going to learn a ton today, and we're going to allow us to kind of move in a few different directions. So ask any questions that do come to your mind here, and feel free to email those over as we go. So that being said, Chris, I really do appreciate you joining us. I mentioned before a little bit about Infinity and kind of how I got to know them, but I'm probably the only one that knows them as well as I do on the call. So can you tell us a little bit about yourself, Chris, and a little bit about Infinity, if you don't mind?
Yeah, of course. And I just want to thank you and the Advisor Network for having me. We have been friends with Colin, for a long time at the firm. And when we originally connected with you to hear about what you were building at the Advisor Network, we were super excited about it. Wanted to find a way to come on board and are proud partners, to, solve for alternative investments, experts, hopefully, with you all. So, yeah. And then I called you last week. I said, you know what, like I could drone on about different topics and alternatives for 30 minutes, an hour, or whatever. But I think most people would agree, like conversational is always better. If you have any questions, please feel free to interrupt me. Would love to make it interactive. So, really proud and excited to be here and want to thank you all for your time. But yeah, so, look, I'm a North Carolinian. I was born and raised here. I went to East Carolina in Greenville, North Carolina. I got an economics degree, and right thereafter, I moved here to Raleigh, where I am today. I got a job with Fidelity Investments. It was kind of a call center environment, but it was one in which, they put us through the brokerage kind of training program. I got my Series 7, 66, and was in a role where I was talking with 401k account holders at Fidelity, really about anything kind of they wanted to know. And oftentimes it was retirement planning, which is obviously a big component of overall financial planning and portfolio management. But yeah, I mean, it was conversations from Roth or pre-tax, like should I which mutual fund in my 401k makes most sense, and all that good stuff. So a lot of my colleagues there kind of went on to become advisors. It was really kind of a great entry level stepping stone role into the advisor profession. And, there I knew I really wanted to further kind of my education via certification and became really interested in alternative investments. I pursued the Kaya designation, which, after kind of getting some educational background there, I was able to kind of move into an alternative investment firm here in Raleigh, Hatteras Investment Partners, which it's founded by a gentleman, David Perkins. He also co-founded Cap Trust. In many ways, he was an alts pioneer in the early 2000s and late 90s with various fund of fund structures and the private equity world. But that was a lot of fun. It was really educational. I learned a lot working there, and just kind of through building my network and primarily, building relationships with advisors and the private wealth channel was connected with the folks here at Infinity. When I learned what, we were building here at Infinity, I was excited to jump on board. And yeah, I mean, I took a remote job. We're based in Atlanta, and it's been a really fun ride, Colin. When I started at the firm in 2021 Q1. We were just under a billion in AUM, and now today we're surpassing kind of that $2 billion threshold and climbing. So yeah, as the biz dev kind of IR guy, I wish I could take credit for all that growth, but I mean realistically, we've grown kind of from any which way, whether it's investment performance, capital appreciation. New flows and advisor relationships, and actually, a really, one of the latest and greatest updates is via an acquisition. So, it's been really fun.
Yeah, I mean, obviously, I've followed you from the beginning. You mentioned our relationship and that. What's interesting to me is I think your firm is growing incredibly quickly, but there's a massive shift going on in the world of alternatives. And you can see it
Yeah.
at any conference you go to. I think, I think it's something that is hard to put your finger on exactly what it is, but I do feel like the asset class is really getting a lot more attention than it ever has before. Kind of what are some of your thoughts of why that might be the case?
Well, I mean, I think that's a really good open-ended question. I think there's a lot of ways I can answer it, but I mean, alternatives have certainly grown in popularity, but like I said to you, kind of on a call the other day, I mean, I think they've also grown in terms of, portfolio allocations across the board through necessity, right? It is a interesting kind of somewhat challenging environment that we're going through right now. Just when you look at everything going on, a term that's thrown out really quite often is uncertainty, and we can get into kind of the current, macro and micro environment. But, realistically, I think advisors and investors are really challenged to, build appropriately diversified portfolios when looking at just publicly traded options, right? Like, i.e., stocks, bonds, maybe, anything securitized and daily liquid, right? Correlations and betas are running higher and closer than they ever have, and we're even seeing that with just standard public fixed income correlation, right? It's I think the diversification benefits there are decreasing at least over the last few years, and again, I think it's challenged a lot of allocators to really kind of rethink what the standard portfolio is. We hear a lot about the 60/40, but nowadays, maybe it's a 50/30/30 or a 60/20/20 or what have you. And the reason is, I mean, when you think about I try to make things simple, right? Like if you think about any new investment opportunity, you're going to want it to solve, I mean, at its core, probably two goals, right? I mean, it's either going to be long-term capital appreciation or risk mitigation, right? Like lowering portfolio volatility. And for a whole host of reasons, and we can get into it. Alternative investments through years and years of data and returns have proven that they can help solve for some of those needs.
And I'm gonna pivot off something you just said a second ago. I want to come back to a little bit more about, infinity, but I think we'll have an opportunity to do that later. You talked about right now the global investment landscape, and you did talk about I won't call it the death of the 60/40, but there's a lot of talk, just at Morningstar last week, there's a lot of talk about that there's a better way, right? But there's been a better way for a long period of time. And I guess the question is, you talked about those two different ways that alternatives can be helpful to a portfolio. Usually you're trying to add something for one or both of those, but alternatives seem to be able to solve both of them. At least some types of alternatives can
Yeah.
solve both of them, right? At that point in time. Talk to me a little bit about that, about how you're seeing advisors out in the field using those to get more into that, 40/30/30 or some iteration of that type of environment.
Yeah, and I think you're right. I'd love to kind of just let you know who we are, so it gives a little bit of context
Yeah.
on what we do. But most of our investors are advisors, right? And they're our typical kind of client, if you will, is an independent RIA, right? So we've been servicing the private wealth channel for over 2 decades. We've been around since '02. So That is a question that's near and dear to our heart. And I think advisors and more importantly, clients and investors use alternative investments, just speaking real broadly, in a number of different ways, right? We have kind of deep roots in relationships and allocation track record in the hedge fund space, right? And there's a lot of different kinds of hedge funds. So you can look at maybe a more volatile and juicy hedge fund in the quant world or macro that might probably be looking more like an equity replacement, or you could look at maybe a market neutral multi-strategy hedge fund that kind of serves as a fixed income kind of replacement, right? Like a portfolio ballast, low vol, low correlation, right? So, and that's just in the hedge fund asset class. So as you can imagine, right, like alternatives are really kind of all encompassing of lots of different types of strategies. And I think also you look at private equity. I think that's a really interesting space. I mean, admittedly, we haven't done a ton there, but companies are staying private longer. I mean, that's just something that we've seen. And the reality is for investors to get exposure to kind of that value creation that's being captured in the private space before companies go IPO, you're going to have to go in the private equity markets to tap into that. And there's also, I mean, kind of thinking that value creation, there's a lot of innovation at that smaller non-public company stage pre-IPO.
You reminded me of something that I forgot to do at the beginning, so I have to do it right now because people are going to be listening and jumping in the call.
Yeah,
We have,
go
we
for
have
it.
folks from all over the place, broker dealers, RIAs, other parts of the world. One of the key things to every call that we run is an important disclosure. You're going to hear things on the call today. Chris is going to share ideas and alternatives. I'm going to prompt him to kind of go further into strategies and ideas and things. Um, Make sure that you consult with your firm, your compliance with any local regulatory bodies, whomever it is that defines the investment options for you and the choices available to your clients to make sure that before you make any selections and alternatives, you understand what's available to you. So we may be talking about something, it may or may not be available on your platform. And that's okay. It's important. That's why we start talking about the asset class. We start talking about the area, the platform, a number of those things. And then the question from you will be, do you have access to these type of strategies on your own platform? Hopefully with Infinity, if that's a possibility going forward. But just wanted to add that because I want to make sure everybody follows the correct compliance procedures, or I'll get myself in trouble without saying that. So you now let's come back to the intersection here for a second, right? So you just gave us a good understanding of what's been built, and I'm going to spend a lot more time in a little bit about kind of what Infinity has brought to the table because I think about the alternative industry as starting with just having this few hedge funds available 20 years ago when I started to having access to multi-strategy fund of funds like the one you used to work at, and then working our way into now what seems like thousands and thousands of alternative investments. But the reality is that it doesn't necessarily mean there are thousands and thousands of true alternative investments. Talk to me about that landscape a little bit, Chris, about the idea that we have now gone from having only a couple of choices 20 years ago to having what feels like 10,000 choices 20 years later.
Yeah, look, I think our industry is fascinating because of how it is constantly evolving and kind of the dynamism of capital markets in general is it's probably why we're all in it, right? It's probably at least some aspect of why we're all interested in investing and in economics and in capital markets, right? But I mean, just speaking more broadly, I mean, we've seen a lot of evolution in the alternative investments industry. This predates my tenure in the business, but in kind of the 80s and in 90s, to your point, I mean, there was, probably a whole lot less options and access and availability of a lot of really good managers was probably difficult. And, I think, what you found was it was almost entirely limited to the large institutional investors, the big endowments, sovereign wealth nations, maybe call it, billionaire families, right? Like that type of capital base was really what it was excluded for, and the large endowments really was what famously kind of brought alternative investments to become popular. But over time, people really kind of realized like, hey, maybe there is a place for alternative investments in kind of your average high net worth and high net worth individual and family's portfolio. For some of the reasons I had mentioned earlier, right? Like return appreciation, risk reduction benefits, all that good stuff. And I think, I generally believe for the most part, the industry kind of evolves in a good way. Again, really to allow people to serve clients in the best way possible and ultimately leading down paths to building better portfolios. And, just speaking in terms of Infinity, I mean, we got our start in 2002, to your point. We were running a fund of hedge funds, which we actually still manage today. And kind of the way our business has evolved is it's a specific example, but I think it's a good one to point to and how the industry has evolved, right? In the early 2000s and early 2010s, the fund of funds construct, I think, was a really interesting and, in a lot of cases, exciting way to get exposure to some of these, premier world-class alternative investment managers. And you know, the thing about alternative investments is, I can talk a little bit about the benefits, but there's also some complexity around it, right? Like accessing the best managers can be a challenge, whether it's from high minimums. Some of the managers we're invested with are hard closed. They'll
Yep.
probably never reopen. So even if you were to write a very large ticket, they're just going to send you packing, right? So, at the time, the fund of funds program was a really great way to get meaningful exposure, if you will, to some of these hard to access world class managers and what I would refer to as kind of more of an investor friendly structure, right? Like our interval fund can accept $25,000 minimums and produces a 1099. Now, I think the industry has evolved through, I guess, what a lot of people refer to as the democratization of alternatives. And that might have been mentioned at the conference you were at recently, Colin, but I think it's kind of a good encapsulation of what we've seen over the years. I think you're seeing a scenario where a lot of the world, good top tier world class managers are interested in diversifying their LP base outside of kind of more of the chunky, large institutional investors down into the private wealth channel and really kind of open the doors for anybody who's, truly accredited and it makes sense for their portfolio. And, whether that's lowering minimums, kind of fee compression in a way or what we run are feeder funds, right? We, through a master feeder structure, have set up feeder funds to invest directly into alternative investment managers that we like, we've underwritten, we've built relationships with for a long time. Maybe we have a position with them with our off-the-shelf commingled fund of funds, or maybe we've just known them for a long time and we really believe in their business. But effectively, the feeder fund serves as a direct access vehicle to go directly to, I'll use Point72 as an example. We have a feeder fund there. I don't know if there are any baseball fans in the house. Steve Cohen runs Point72, is the owner of the New York Mets, but he charges a $25 million investment minimum to go direct. And, I think for a $25 million high net worth individual or family like that, there's a mismatch there. But, at our $100,000 minimum at the feeder fund level, they can get a appropriate bite size to get that exposure. So that's just an example on the Infinity banner. That's happened really across the board for the better and allowing investors to kind of swim upstream and really peek behind the curtain and get access to some of the best names out there. Which I think having access to the best managers, the top quartile, top decile folks is really where it's at, right? Like that's really where you'll see more of the true allocation benefits of, sacrificing the liquidity and maybe transparency that comes with alternative investment allocation.
Yeah, a couple of good points you made in there that I'm going to focus on a little bit on some of them. You did talk about talking to clients and using this as an opportunity to prospect. And I think what is unique is great example with Steve Cohen. I was going to make a joke later about, most of the big names that you have seen, some of these historical, unbelievably successful folks own sports teams. They own, they're massive names in pop culture and other types of things because they've done so well for so long. They were trailblazers in the industry, but you do have access to get into a product that there's absolutely no way to get into, and a few others that you've historically brought access to. It's such an unbelievable shift from that access all the way to this new world of ETFs providing this idea of, I'm going to finger quote it on this, the alternative. I know that there is alternative exposure that you can do. So I'm going to start with this question. We're going to have a couple of things around here. I already got one in my email, so I'm going to weave that in here in a second. But, the question I would ask, Chris, is so what are some strategies that you can really only do in the less liquid environment? And what are some strategies that might be available in the more liquid environment? Call it mutual funds, or you even talked a little bit about an interval fund, which I'll explain in case someone's ever heard about that. That's a lot of liquidity. It's not full liquidity. You have the ability to buy in daily, but you're able to exit quarterly on a particular date, meaning that the minimums are lower. You have the great tax treatment of a 1099. So if you've never heard of that structure, that's a little bit about that. But what are some strategies that fit well into the less liquid bucket? And then what kinds of things might you see in the more liquid bucket?
Yeah, and there's a lot to kind of talk to there. Admittedly, I'm not as versed on the liquid kind of alternatives, ETF, wrapper type products, if you will. But I think, and just kind of going back to the earlier point, like the evolution of the industry, we've seen a lot more of those types of opportunities come alive. And I think people are starting to get really creative on how to implement complex and maybe uncorrelated strategies into more of a daily liquid traditional type structure, which I think all of us want all three legs on the stool, but oftentimes you can't have all three, right? Risk, return, and liquidity. And
Yep.
I think that really is true. There are certain trading strategies and security types and ultimately investment business plans that we believe aren't really executable in a daily liquid structure, right?
Mhm.
And I think short selling is a really good example, particularly in the hedge fund space, because short selling can really lead you into trouble if you're in a daily liquid structure. You have
Yep.
to be right and you have to be right now, right? But in an illiquid structure, you can have some more time to really capitalize on that opportunity. And, in some cases, I think that really helps. And really in the hedge fund space, I mean, a lot of, especially some of the managers we work with, they are executing extremely complicated trades with, less liquidity. They might be borrowing currencies of a foreign market and investing in other currencies in ours, right? So that's just a really basic example of all the different types of complicated, less liquid type trading that can go into an illiquid hedge fund structure. But ultimately, we all invest to get paid for risk, right? And when you add illiquidity risk, you should get paid for it. And if you're with the right partner, ultimately, we believe you'll see those results in the net returns. So, just speaking in terms of hedge funds, just in kind of short story long, I would say, the illiquid structure is going to be more suitable for those more complicated trading strategies. Think swaps or carry trades or short selling. Now, I'll kind of go through a real estate value add example. We run an affordable housing business. It's a value add multifamily play, and we buy a property, we add renovations and kind of fix it up, and then we ultimately look to sell it. And a daily liquid structure would not really allow for you to properly do what you need to do there because it takes in our instance maybe 12 to 16 months to renovate the property and then it could take another 12 to 24 months to sell it, right? And we believe our investors are awarded interesting and what we believe are pretty solid risk-adjusted return outcomes for taking that illiquidity risk, but it's just not something you could do in a daily structure, given again the lack of liquidity in that specific asset being a multifamily apartment complex. Now, having said that, obviously there are daily liquid REITs that are really large and might run those transactions on a large scale, but to run it through kind of more of a concentrated portfolio at that level, it would require that illiquidity. And I think private equity is another really good example, right? You look at venture capital, you're coming in early days and looking to build that business and ultimately sell it at a 10, 20, 30x multiple, maybe even higher. But that takes time, right? So that's kind of a buy and hold long-term type structure, which, obviously the daily liquid, publicly traded stuff, you're not going to get exposure there. So
And let's do this for a moment, because again, I think there's lots of different knowledge bases, right, for folks that are on the call. As Chris talks about, this is a real estate fund that does some unique things that he's talking about and has a return profile and a risk profile to match that. At times we talk about REITs, we're talking about sometimes publicly traded REITs, and then there's obviously other forms of that. Chris, I'm sure you'll agree with me. I mean, publicly traded REITs traded on the stock exchange tend to act a lot more like stocks than they do necessarily like traditional, sort of private real estate. Would you agree with that statement?
I would, yeah. I mean, securitization kind of when you can trade things daily and you run into, I mean, you see it in down markets, right? When you run into periods of turbulence, folks go to cash, they go to treasury bills, gold, other various commodities, right? Like those types of strategies. And, it kind of creates a scenario where correlations run really high in stocks, bonds, publicly traded REITs, all those things because of the ease in which you can get out of them. And I think a less liquid structure can also there's a lot of psychological study around it, but a less liquid structure can also actually be a benefit to investors in stressed, turbulent environments, just simply because you can't pull it out and make a mistake because you're having kind of an emotional reaction to what you see markets doing.
So that actually is a good segue into the first question that I got in on email, which was you said earlier about that you have not invested in private equity yet, or at least made it sound like a fully meaningful. And the question from the group was, sort of why not? And then if there was an opportunity in front of you, is there any reason you couldn't?
No, so there's definitely not a reason that we couldn't. And we have looked at private equity asset class a lot, and we've done a little bit there. It's just candidly not just a strategy that we've done a lot in. And we at the infinity level, and maybe in a minute it makes sense to kind of get into who we are, so there's a little bit more of a backstory. But we've always tried to stay in the lane of where we feel like we can add value. And originally, it was in the hedge fund space where we launched our fund of funds. We had kind of really deep relationships with what we believe to be our world-class managers, and I think an interesting access vehicle through our fund of funds, which, as I had mentioned, evolved into kind of a direct access feeder fund platform. But we've allocated pretty much across the alternative investments spectrum over the years. I think we've done a lot of fun and interesting things like music royalties. We've gone down the road of whiskey finance and spirits. And we have participated in some private equity deals, but to date, it's just not an area where we've been able to step in and truly add value compared to the other really good players out there. I would say maybe something we've noted is that there's been a lot of assets flown into that space over the last 10-ish years.
Yep.
I think it's gotten somewhat frothy. It's kind of like the private credit market,
Yep.
which we're in as well. We actually have a private credit direct lending commercial real estate business. The gentleman who leads that actually spoke on the last call, which was I think
Yep.
a really good one. But
Yep.
I mean, hopefully that answers the question. We obviously are. We are investors in private equity. It's just not really a solution that we've done a lot in, just because we haven't found kind of the right opportunity where we would truly be like a value add compared to what else is already out there in the industry. There's a lot of private equity players currently in the space.
And I'm going to reiterate for anybody who came on the call a little late, because I did let some people in through the waiting room a bit ago. We are taking questions. You can email them to me, chealy@theadvisornetwork.org. Keep them coming. I think I just heard a beep, so I might have another one already. But we did want to get, and we've worked a couple angles here, and I want to come back a little bit about Infinity and kind of where you're going, right? We started this question about talking about the industry of alternatives, and that I say an asset class. The reality is your sub asset classes with these products, a whole host of them. And so you brought up a while ago, endowments, right? Endowments and foundations, and originally the Yales and the Harvards and the Duke universities and some of the other folks. I know North Carolina, near and dear to some of the places used to work. The world was at that point, that's where the alternatives were for, because they had 100-year lifespan. And now we've pivoted all the way, and I'll answer this one because you mentioned before it's not your world. I'd say to all the advisors out there, there are plenty of places for true liquid alternatives, individual mutual funds and or exchange traded funds. Just be careful and know what you're buying, right? Make sure you do the work and understand what strategies can and can't be done in that space. The reality, though, is somewhere in the middle, Chris, is this area where you can identify great names, the way you mentioned earlier, and you don't necessarily have to have 100-year time horizon in order to kind of take advantage of that. So I wanted to talk to you a little bit about how those relationships, I know that a lot of them are deeply seated, but how they form and then how that allows you access. How is it you can do that? How do you get access to Steve Cohen's fund, other ones in which someone that might be listening on the call today has a client, they don't know how to get their, even a prospect, they just don't know how to get that person across the goal line because they're kind of have the same general planning and the same general public investments available. How does it work, and how would that kind of an investment happen with you guys?
Yeah, so I think maybe I'll just take a quick step back, and then I
Please.
think it'll kind of get to the question there. I mean, I just kind of want to introduce Infinity and who we are real quick. So there's a little bit of backstory. We're an alternative investment manager. We've been around since '02, and I think I mentioned it earlier in the call. Actually, we manage about 2 billion in assets. It's really spread across kind of three distinct verticals here at the firm. We have what I would consider is our external multi-manager platform. We kind of have a lot of different solutions there. We have a number of different fund of funds strategies, which is simply an investment structure that invests in other alternative investment funds. So for the advisor that may be looking to kind of make the jump from a fully public traditional stock bond REIT whatever portfolio into alternative investments, the fund of funds might be a really great way to, or at least a good idea to look at it, right? Because through a single allocation, you'll get immediate exposure to a diversified pool of alternative investment managers. In our cases, it's mostly hedge funds, right? But it's just one subscription, one allocation, fully diversified, kind of pre-baked portfolio. And that really is a way to get instant exposure to managers that are already closed or hard to access. Maybe they have high investment minimums. Now, we also run two internal strategies here at the firm. I just think it's worth mentioning. They're both in the real estate space, one of which is an affordable housing strategy, the other is a direct lending commercial real estate credit business. But we've done a lot of different things over the years. I think I mentioned earlier. I mean, we've allocated to music royalties and reinsurance, asset-based lending, like pretty much across the board. And relationships, really, you don't those don't just come around easily, right? There's no kind of scientific method to how we have a relationship or maybe better access than different groups out there you might find. But I think ultimately it's kind of simple, right? Like we've been doing this since 2002. We've been really good partners with groups that we've invested with. We tend to roll up our sleeves and do pretty heavy due diligence, and ultimately we're also sticky capital, right? Like if we're going to invest in an idea, a manager, a strategy, a business line, we're going to be pretty convicted and excited about it. Like we'll have reasons to back it up. We'll do our homework, and again, it's designed to be sticky and ultimately a solution. So, I think this is kind of a good precursor to kind of introducing our portal and platform Infinity Marketplace and really kind of where we see ourselves in the world adding value there. But the relationships and ultimately like what we can present to you all in terms of exciting manager access really comes from again just kind of some of those concepts, right? Like being good allocators, um, you know being sticky capital, having relationships and introductions in the space, and again also servicing the independent private wealth channel. So we've seen really exciting and interesting opportunities to be really the exclusive and sole provider of a feeder fund into some of these managers that you might not see elsewhere because of kind of some of those reasons mentioned. But the alts business is probably similar to most businesses. I mean, it's very heavily relationship driven and people driven. Really, any which way you look at it, whether it's a team that you're investing in, you really got to understand the people that are going to be trading and investing the capital, or at the management level, the people, underwriting the deals and managing those relationships.
So, question that came in. This is one that you answered a little bit here, but I'm going to let you maybe extrapolate a little bit too. Uh, I said earlier, they noted that I was the one that said there's lots and lots of types of hedge funds that are available. And the question that comes in is for those that are not familiar with every underlying strategy, how can they make the right choices versus if they've never done this before? And you kind of addressed the idea, or is there a one-stop shop? It sounds like obviously the fund of funds for someone who's never done it before might be a good option. But what is it like if someone's never done this to maybe work with Infinity and get educated on making their own selections of what some appropriate investments would be for a client in the alternative world?
Yeah, no, I appreciate the question. I mean, there's a couple ways, right? Whether you're with a large firm or you're with kind of an independent, private wealth RIA firm. I mean, ultimately you could look to hire an analyst focused on private markets that has a little bit of experience there, and we've seen a lot of folks do that, or you can outsource that expertise, right? And again, I think that's really where we see ourselves. We aim to be alternative investment solutions providers. We try to be experts in kind of this business, and we want to share our research, our due diligence, and our findings and our thought process with the allocators, advisors, and investors that we work with. So that can come in many of different ways. I mean, you might have you might be really, really knowledgeable in the private equity or venture capital or real estate space, but just not as versed in hedge funds, right? Or vice versa. And ultimately, I mean, we really aim to kind of be that outsourced alts expert, if you will, via some of the solutions that we can show you and ultimately the research and due diligence that we can also show and kind of collaborate with you on. So it can look and feel a number of different ways. And I've talked a lot about the fund of funds construct today. I also think that's an interesting kind of concept for somebody who's just looking to dip their toe in the water and get started in investing in alternatives. Being that it's a fully baked, diversified, built out portfolio already, you're not taking that single manager, single commitment concentration risk by going direct in another way, right? That immediate diversification and exposure, I think, really can help for that too. So, yeah, I hate to respond with an open-ended answer, but there's really a bunch of different ways that that can happen.
Well, no, I'm going to add on to your answer and just talk a little bit about, I think this is a world that if you've not spent a lot of time in it, maybe you've been a little afraid of it in the past, you don't need to jump in head first. There is the toes in the pool option. And the other piece too is education, right? Going
Yeah.
through a more of an education process. I tell you, if you learned about this 15 years ago and you relearn about it today, that it is a different world. There's different vehicles. 1099s are a wonderful thing now. It used to be much, much more tax inefficient and complicated and frustrating and lots of other things. So that's a really helpful opportunity to get some education, learn a little bit, let Infinity guide you, and kind of help you understand what you're looking at, so you can feel comfortable talking to clients about it. You don't need to be the expert, but you obviously want to be conversational and make sure that you understand what you're working on. So let them educate you. Another question that came in here, and I just want to let everybody know, we have an hour booked. We try to keep about 50 minutes in, so line up another couple of questions for me. We had some other things prepared otherwise, but I'd love to use the time here as it makes sense. And the question that came in here, Chris, is on due diligence. And you mentioned the word due diligence. My guess is there's still some people old enough on the call that remember Bernie Madoff and remember some of the
Yeah.
things that maybe gave a black eye to the industry a little bit. Talk a little bit about due diligence and how that works with Infinity. It's a great question, by the way.
Yeah, I mean that's obviously very important. I think one of the things specific to alternative investments, I guess I should maybe walk that back a little bit. It's not specific to alternative investments, but I think the requirement really for proper due diligence is expanding just beyond investment due diligence and really keying into operational due diligence so
Mhm.
that you're going into the office and you're going to meet the people that you're allocating with. I mean, we generally do, I want to say 2 to 3, maybe even more on-site visits, like actually meeting the traders, the people who run the shop before we're fully comfortable and have gotten to the, air quote approval on platform kind of label. But yeah, operational due diligence is key. I mean, a lot of private investments aren't regulated by the SEC exactly in the same way that a mutual fund would be. So, I mean, you really need to get comfortable with, again, the management team, various service providers. I mean, we're going to figure out who's auditing, who's the administrator, who's the custodian. If it's not one of the big groups that we already have direct communication and in a relationship with, likely. I mean, we're going to need to kind of underwrite them too and get to know kind of the ins and outs there.
Yep.
We'll call other investors and get kind of a reference check. That's always pretty interesting. Of course, the references will probably be introduced by the managers, so they'll likely have good things to say. But that's a really important step. Um, and then, of course, I mean, you need to look at kind of the investment side as well. You want to figure out, what is driving performance? How are they managing risk? Is it repeatable? Who are the key people? What is their tenure? How quickly have they raised assets? Has it been stable? Are they open? I mean, there's a whole host of different kind of due diligence boxes that we need to check. But one of the key differentiators, I think, from your typical kind of traditional market diligence between alternatives is in that operational space. Again, because it is a less regulated area, which is vital. At the infinity level, I mean, we typically spend at least 2 years getting to know a group. We try to keep our pulse on, the kind of, I say the markets, but the different, sub asset classes in the alts privates world that we like, that we're interested in, that we're probably participating in. We try to kind of know the players and look, I sit here in Raleigh, North Carolina. I'm one of the few remoters, but our office is based in Atlanta. When folks are coming through Atlanta and they reach out, we're oftentimes happy to take a meeting just because we're an intellectually curious bunch and we really kind of want to know a little bit about, all the different folks out there. So, the due diligence machine never stops. We're always making sure we're staffed accordingly to keep it going. And there is truly a lot that goes into it.
Yeah, I'm going to ask you another one, and I'll invite. We're getting towards the end here, so ask any more questions that are on your mind here for this. So I'm going to piggyback on due diligence for a second because Chris is right. There's two types of due diligence as we talk about this. Just so you know, Chris is talking about operational due diligence, unbelievably important in the hedge fund world. You need to know that those boxes are checked in the right fashion. Then there's investment due diligence, right? Does it meet the parameters of what you're trying to do to accomplish within the plan? And just a little bit of an aside from that, you know, the hedge fund boom that occurred a few years ago or X number of years ago, now maybe the private equity boom that we kind of talked about, there were people in their garage, right, that were set up that were, a hedge fund, and they actually were
Yeah.
incorporated to be a hedge fund, but they wouldn't have passed a single part of your checklist along the
Yeah.
way. So it's really good to get to know those folks. Just for those that are putting their toes in the water and understanding, Chris mentioned hiring someone to do it on your team to do it. It's a lot of work. It could also be quite expensive. If you're gonna evaluate whether it makes sense, spend a little time with Infinity Funds, get to know how this process works because you certainly there's no shortage of an amount of time and expertise needed to do the amount of due diligence these folks do on that. So just a little bit of an aside for you on that.
It is
Um,
expensive. We always joke. I mean, and I feel like we talked a lot about hedge funds today, but we kind of crack up. I mean, you and I with a couple tens of thousands of dollars could go set up an LLC or a limited
yeah,
partnership, and boom, we're a hedge fund, right? Like we always joke like we're not typically placing, or really in any instance placing capital with the two guys with the Bloomberg terminal and their grandma's garage trading with a Labrador Retriever sitting on the ground, right? Like. But I mean that is a hedge fund. So there's
yeah.
just a huge kind of difference in all the different types out there.
I'm going to ask you this last one here and invite any last questions, right? So we went through and we prepped, and I think one of the things that is the most challenging, you look at a guy like Steve Cohen, He's looking to get as much intel and make some incredible trades. The last thing in the world he wants to do is share that information, right? Because
Yeah.
that's his edge, that's his opportunity. And that is the thing that I think scares some clients. It certainly would scare ultimately maybe the, advisors, and it would certainly scare end clients at times of saying, I don't know anything about these guys. You mentioned due diligence, and there's somewhere in there's you can know everything about the firm and what they do, but sometimes you don't know exactly what they're investing in. And maybe talk to the group a little bit about the idea of where that wall is, I guess, between that process and kind of how they invest.
Yeah, no doubt. I mean, first of all, I just want to kind of take a quick step aside. I mean, I really appreciate all the questions. It makes this a lot more fun for me. So thank you
Mhm.
all for the interaction. I've really enjoyed it. But yeah, I mean, that really, I mean, this again, big picture alternatives conversational point. That is transparency. And when you look at a private equity firm or a real estate business, or in this case, a hedge fund, there is going to be just a massive lack of transparency and position level details, and ultimately that kind of aids to some of the higher, really solid risk adjusted return performance numbers that you really expect by taking that, again, illiquidity risk and ultimately experiencing the lack of transparency. And a lot of it has to do with how the market would react by knowing what a multi-billion-dollar super successful hedge fund manager, what their position levels would look like. Folks would just kind of piggyback on it. And
Yeah.
you saw what happened with GameStop. That was a very interesting scenario. I actually enjoyed that Netflix movie that came out on it. But folks figured out that there was a hedge fund really short GameStop, and there was a lot that went into it. Call it nostalgia, call it COVID stimulus checks, and people having a lot of time, and social media kind of blowing up. But I think that's kind of an interesting example where I don't know if I don't want to say that it leaked, but people saw there was a large amount of short interest in a stock like GameStop. Maybe it was assumed, or maybe it was literally known that it was mainly hedge fund short interest, and there was a huge turn on it, right? So that, I mean, that's kind of a good example as to why there is a lack of transparency, but it also works on the long side too, right? Like, this is proprietary information. Um, a lot of quantitative model driven type shops have proprietary quant models. If they shared that with the world, anybody could figure out how to do it, and their competitive advantage is completely vanished, right?
Yeah.
And I think as investors, we don't want that. We don't want to know every position level detail because, again, it takes away from this group's competitive advantage and why we hired them and are paying them the fees we are in the first place.
Yeah, that's a really good answer. And I'm sensing from some of the questions that are coming in, I think education is important, right? So Chris is doing a great job today of reintroducing you to the asset class, reintroducing you to the opportunity set. But the concerns for anybody who's, been doing this for more than 10 years is that, there was a few bad apples that ruined the bunch. There's nothing to say that that industry is worth shutting out. You should reopen your mind to what that could look like for clients because, as Chris started with the meeting, there's some unique and very cool things and great opportunities that are good opportunities for your clients and good opportunities for you to differentiate yourself as an advisor. So I think that's really, really important. Um, I am going to do a last call for questions. All the ones so far have been really, really good. Um, and I'll stop with one here personally because you've already talked about illiquidity. You've already talked about black box. You have talked a little bit about some of the other structures that exist. But one thing that was always a black eye, if you will, at some point for alternatives was cost. And just, you don't have to get into individual numbers, but just talk a
Yeah.
little bit, Chris, about how alternatives price relative to public markets a little bit.
Yeah, no doubt. Yeah, I mean that look, there are certain kind of there's some sticker shock with a lot of different private market and alternative investment managers fee structures, and sometimes for good reason. I mean, nobody wants to overpay for, I mean, frankly, anything, right? I mean, we all work hard to save money and invest for the future, and the last thing we want to do is overpay for beta or overpay for sub performance. And I mean, I think the reality is too, like in aggregate across the alt world and private markets universe, I mean, your kind of median to sub median manager in that space is really not all that interesting from a risk and return perspective. It might even lag like an S&P 500 beta, right? So I mentioned it earlier, and it's so paramount. I mean, you really have to focus on kind of the top quartile, top decile managers there. And really, I mean, ultimately, though, we kind of have a good, interesting take on it. I mean, we invest in some of the most expensive managers out there in the world. It is our, philosophical belief that, to invest with the most talented investors and traders, you probably got to go to the most expensive shops because if you're a stud portfolio manager, you're going to go to where you get paid the most, and obviously that's going to flow through to fees. But I mean, really, just to boil it all down at the end of the day, what does that really mean, Colin? You got to look at net returns and kind of net risk numbers to kind of really see the full story. And if the net outcome is sufficient to, paying the fees and it really is accretive to your portfolio, then yeah, we're game. Sign us up. Again, we want to be with, the top decile, top quartile, best investors on the planet. We know we got to pay for it, and the risk return outcomes should show that.
And I think for everyone that's contemplating this, each fund, we're talking about it generally. If you're interested in a product, Chris or a member of the team can walk you through how that works, right? How they're, the base fee, if they're paid for performance or not. There's a very easy way to go through it, but the point is it's not uniform. So you can't just go to Morningstar and take a look and say this is the number of basis points. You should really talk to Chris, get that education, work through the best channels. And I'm going to use this opportunity before we wrap the call to Chris already said it. I said it earlier in the call. Whatever your product availability is, you need to go back to your firm, talk to your OSJ, talk to your branch operations manager, talk to your chief compliance officer, talk to whomever you need to understand what's available. In a vacuum, I think obviously I would certainly say you need to talk to Chris and talk to the folks at Infinity Funds. They'll be happy to educate you. But just make sure that you educate yourself. If you leave with nothing else from today, the marketplace, the financial advisor world is getting more and more product than ever available. Educate yourself and know what that opportunity looks like because some of the things Chris has talked about today are very unique and they're very interesting ideas depending on the right client. So you got to make sure, as Chris said earlier, we'll just double down that things that are the best ideas for clients, right? And the right client and the right situation for that. If you do have questions afterwards, Chris's information will be posted. This is going to be sent to all of the folks that are financial advisors in not only in our network, but in our distribution channels. So we're going to have this video put out to you. We do anticipate this will be available for CFP CE. So the CFP CE credits will be made available. There's a small quiz at the end that we'll do. So once that video is put out, we'll give you the opportunity to apply for CFP CE credits. And, we really appreciate, Chris, your time. We're excited for what you're bringing to the alternative industry, what Infinity Funds is doing. And I hope that folks take the opportunity to learn more.
Yeah, well, again, I just want to thank you so much. We're so proud to be partnered here at the Advisor Network. I appreciate the time today. And look, I mean, we truly love what we do. If there's any way that we can help, even if we're not available kind of where you are, or we're always happy to talk alternatives or just kind of bounce ideas off each other because, we really are a curious shop, but we're super passionate about it. I think regardless of where you are, what banner you're under as an advisor, there's probably avenues you can go down to find, truly good solutions to build better portfolios, and that's what it's all about. But thank you all so much for the time and really appreciate it, Colin.
Awesome, Chris. Thanks again. All right, everybody, have a great day. Have a great 4th of July. We'll talk to y'all very soon. Be well.
Thanks.